You're about to hear from one of the fastest speakers in the world, and I'm hoping he takes a deep breath and slows it down, but I'm not sure it's possible. Please join me in welcoming Bob Robotti. Thanks, Bob.
Well, what would you expect other than a fast-talking New Yorker? So my talk today is predicated on, it's the economy, stupid. That's what I think is a critical thing that people miss, especially a traditional value investor like myself. I remember Greg Zuckerman from Wall Street Journal asked me in 2018, he says, well, value's underperformed. What makes you think it's going to change? And of course, the answer to that is it's really all about the economy, stupid. The firm itself, I started 40 years ago. We run some private funds. We also have separate accounts. So it's 4 decades of investing. What we've done is, it's really based on Graham's principles of investing that all of us know pretty well, some of which have forgotten because there are certain aspects of it which have gotten accentuated recently. We focus in on small and even micro-cap stocks in addition to mid-cap stocks because we think the size of the opportunity pool is large. We think particularly today it's an interesting place because it's something that investors generally don't look at anymore because investors generally don't look at companies anymore anyway because passive investing has done so much to move capital around. And so we think that that really creates a huge opportunity. The firm itself, so I got out of college in 1975. I was an accounting major and I had the great fortune of walking in to audit Tweedy Brown. And so therefore spent 4 years working with the likes of Walter Schloss, Tom Knapp, all people who had Ed Anderson, all people who knew Buffett, knew Graham, and knew Charlie Munger. So it was a great place, and it was great to me because I was an accounting major, didn't know about investing, so I didn't know the market was efficient, and all I knew was Tweedy was making an awful lot of money, because that's what it was. Tweedy had been around for an awful long time, but in 1975, suddenly, it was the beginning of a period of time of significant outperformance. And why is that? The businesses they were investing in had valuations that were very dramatically discounted, and the economics of the business did really well. And so therefore, the underlying performance was dramatic. And that is, 1975 really is, like post to 73, 74, a market correction, where the Nifty 50 stocks, one decision stocks, you could buy them, it didn't matter the price you pay, you were gonna make money, right? History doesn't repeat, but potentially it rhymes. But so therefore, these stocks had been ignored. And so it really is Tweedy, Ruane, Buffett himself, Gabelli, Mike Price, all these people, that was the beginning of the period of time. So that rotation happened, and I walked in and saw that, so therefore I knew the market was not efficient. In 1980-83, I had the great fortune of spending 3 years as the chief operating officer, chief financial officer for a firm called Gabelli and Company. Mario, at the time when I started to work for him in 1980, managed $7 million. When I left in 1983 to start my own firm, he managed $77 million. It was a 12-person firm. And every day, Mario had his morning meeting, and he went through his favorite investment idea. So that's what I say. I had an executive MBA program in value investing taught to me one-on-one by Mario Gabelli. And for 3 years, he paid me to attend his class. I didn't pay him. So, of course, I was bitten by the bug, wanted to pick stocks myself. No one would pick me to pick stocks, so I had to start my own firm. So in 1983, I started my own firm. Some of the critical events that have happened over time, and critical is, it's not just me, there are 14 people at the firm who live and breathe finding stocks that are significantly mispriced by the market. And so that is their avocation, and it happens to be something we also make a profession at by being good at it. In 2005, Isaac at the time was right out of Wharton, convinced me we needed to invest in Asia. So I said, Isaac, I'm a kid from Queens. I don't speak English that well. I don't speak another language. How am I gonna go someplace else? So he convinced me to try. So I packed up, I moved, I went with him, visited. So we went Thailand, Vietnam, Malaysia, Singapore, Philippines, Indonesia, Hong Kong, 12 cities, mainland China, South Korea, Japan, Mongolia. So he brought me all over for 6 years because he lived for a year in Singapore and 5 in Hong Kong. And so, clearly the world is flat and it's all interrelated, and understanding that part of the world really gave me a fuller understanding of how the world really does work and how the economy works pretty much everywhere, including how it works in North America. In 2016, Curtis Jensen joined us. Curtis was with Marty Whitman's firm, Third Avenue Value, so a significantly successful value investing firm with an orientation toward hard assets, restructurings, things like that, which we do a lot in also, so it was a perfect kind of analogy to our investing too. He had become the chief investment officer, and when they were bought by AMG, the business turned into an asset accumulation business and not a performance-based business. And therefore, they managed, I think, $20–30 billion at its peak. He was the chief investment officer. He left in 2014, sat out for 2 years, and then joined us. So it's an indication of his understanding of how we think about investing, the similarity between the approach that Marty Whitman had at Third Avenue Value, the consistent approach, and is a place that he wanted to share and be a partner with. So he's one of the people that joined us. When we invest in these small cap, micro cap companies, we do it also with a really long timeline and horizon. So we're not necessarily looking that these things are going to perform quickly, but we think that they are substantially mispriced to have a real opportunity. In that process, we get to know the managements, the boards, the shareholders of those companies extremely well and develop relationships that we think are extremely supportive. And in that process, occasionally, we'll end up serving on boards of companies. So these are some of the companies that I've served on the board of. And that experience, of course, is a great experience, right? So then you're on the inside of the company, understanding the minutia of the business and the detail of it. You understand much more about the industries that those companies are participants in, and therefore it broadens your knowledge base, broadens your contact and information. And of course, for that specific company, it has the advantage of we have a seat at the table when it comes to the selection of the CEO, most important selection, and the allocation of capital. So therefore, and we think in the process, we probably added value in that process and also have developed a lot of opportunities that spring from it. So a concept I have is called Brigadoon. So post the financial crisis, right, the world lived in a decade of extremely anomalistic facts. It was a relatively tepid economic activity, right, and that's why the Fed reduced rates to next to nothing with the intent of a trickle-down theory. If we make the cost of capital nothing, that will encourage economic activity. A total failure on the part of the Fed because it did not encourage economic activity. Instead, it had the unintended consequence, of course, of depressing the cost of capital and therefore resulting in a substantial misallocation of capital, we believe. And so that distortive effect is really something that also, and then of course you had that at the end of a 30-year period before that where interest rates had gone one way. So they had gone from 15.5% and of course ended up at 1%. So therefore, you have one part of one cycle over 40 years. And you've got 10 years post the financial crisis of this situation where people said, this is the new norm, right? Including the advisor to the, so I chair Pace University's endowment committee. So our outsourced CIO, who's a very famous, well-known advisor, said, no, inflation's something that's gone, it's not there. This is the new norm. So therefore that idea, but more importantly, the allocation of capital is permeated by the idea that that decade really was the new norm. And so, we thought clearly one of the main beneficiaries of that period of time has been private equity, right? And so people talk about today capital and say, well, passive is now larger than active. And of course, the reality of it is not only is passive larger, active, you've always had closet indexes anyway. And the closet indexes are now the vast majority, if it's not an algorithm, who's trying to copy what the index is doing. So therefore, the allocation of capital today, we think, is really substantially distorted by those kinds of forces, and it's not analyzing companies, identifying situations, and identifying mispriced securities and investing in them. And as I said, that the main beneficiary is also that private equity. And that private equity, of course, is almost as big as the markets are themselves, the passive and the active piece. So a huge amount of capital is that piece too. And so that's drawn off. And of course, the problem with that is you're in for 10 years. So you don't have an exit opportunity. And even now, if you're at the end of the 10 years, there's a lot of exits that aren't happening because of problems. And the problems, of course, is the bid-ask spread, right? The sellers of those businesses have them priced at this number. The buyers of those businesses are interested in paying this price because the 10-year treasury, the risk-free rate of return, is vastly different today than it was 2 years ago. And the markets haven't adjusted cap rates to the new reality yet. And they're hoping, this is Brigadoon. So Brigadoon was a play written by Lerner and Lowe in the 40s. And it was about these two gentlemen who go to Scotland on a vacation. They're wandering around the moors of Scotland. They come across this little town, Brigadoon, and it's a wonderful little place, and they love the place. And they come back the next day looking for it again, and they find out it's not there. And someone tells them, Brigadoon only shows up one day every 100 years. And that's what you have today. You have a market that has allocated capital substantially based on a decade of low growth, low interest rates, free capital, and the allocation of that, and a big piece of that is in private that you don't have the ability to exit. And so therefore you are really locked in. So capital today, we believe, is substantially misallocated based on the economics, stupid. The economics for the last decade, those are the beneficiaries. That's where you wanted to invest. But the world is different, and that difference is clear and identifiable, and the process of change we think is accelerating. So Brigadoon, financial Brigadoon, if interest rates come back down, then I can get back to this wonderful world that I had. But it's not going to happen. So it's all about the economy, stupid. Right? So the first, on the chart on the left side, so that's what you have. Every decade, the winners change. Every decade, the winners change. Why? Because the underlying economic environment changes, and the beneficiaries are not the ones who were the beneficiaries before. So what determines which industries, which countries outperform, are which ones are well-positioned and are the beneficiaries of growing economic situations. That tends to always rotate. And so that's what we think is in the process of already unfolding today. Then, of course, you had this extended period of time post the financial crisis. It's, things go in and out of favor in different points. And, of course, I really think the idea of value stocks aren't going to perform because I'm going to go out and buy value. So the markets trail the economics. They follow the economics. That's what it really is. So you don't go buy something because it's out of favor. You buy something because it's getting into favor, and it's getting into favor because its economics have turned, are improving, and have dramatic growth. That's what pulls capital in. But yet industries, in a financial environment that we had for 10 years, the rotation didn't happen. And I suggest that the rotation is in the process of starting. So we all know this line, right? Past performance is not a predictor of future results. So we know it, but does anybody do anything about it? Are any of the large endowments and institutions changing their capital allocation in the last 3-4 years? Even though there's cracks, they see signs, and what are they hoping for? Brigadoon. No, it'll go back. Inflation will come back down. Therefore, and interest rates will come back down. It'll happen. And so therefore, it'll take time because it won't happen, and there are reasons to believe that that's not the case. So that's the opposite. And then down below, I have the comment by Bernard Baruch 100 years ago. Right? Information is no substitute for thinking. So think about that. 100 years ago, when information, like what information was there? There wasn't really much information. And what did you do with it? You took out your paper and your pencil, and you did calculations. Think about today's world. The flood of information and on you all the time. And that flood of information is contradictory, is confusing, but also what it does is it shortens your time horizon. It makes you more myopic. I am focused on more what's going to happen in the next month or 2 or 3, and not what the next 3 to 5 years, the opportunity is. And those trends we think are clear and obvious and identifiable, and capital is very slow to move there, and we've done that over time. Right? The stock I talked about last year was a company that for 5 years nobody cared about. It traded because the outlook for the earnings were uncertain. Today, those earnings have clearly manifested. That stock has performed tremendously. So the idea that capital, because people occasionally say that, well, I know, even if your results improve, well, maybe the capital won't follow. Capital follows. It's looking to get returns, including, since one of the things we do is invest in fossil fuels, energy, conventional oil and gas companies in the last 3 years have performed well. Why? Because suddenly people say, oh, I want to buy a fossil fuel company. Oh, I want to invest in something that creates CO2. I want to do that. No, it's because the results have been particularly strong. And therefore the economic results, in spite of all of the social issues that would keep people, right, it's the third of all mutual funds in Europe, don't own any oil and gas companies. So in spite of the institutional aversion, stocks perform, the results are strong, the stocks perform. So therefore, money follows performance and the economics. And the passive flow of funds, we think, is part of what's creating the opportunity, because where are people looking? They're not looking. First off, they're looking for, how do I figure out which index I want to buy? How do I figure out, the last 3 times this happened, and maybe this should happen this time? So it's all this wild speculation kind of thing. So the flow of funds, we think, eliminates the idea that you should do bottom-up stock research. And we think that there's a huge number of companies that have been forgotten about. No one has an interest in industries and companies, and therefore, for a stock picker, it's much easier today to pick a company that is substantially undervalued. Valuation matters. Valuation's critical. So a lot of what we do is invest in companies that are cyclical. And the reason we do that is when a cyclical business goes into a cyclical downturn, the businesses get discounted. The advantage over the last decade plus is that cyclicality in those cyclical businesses has been worse than normal because the economic environment has been weak. And in addition to that, you lay over many other structural issues. If you're an industrial company in North America, for 50 years, you've been at a competitive disadvantage because there's another country in another part of the world that now has things become the second largest economy in the world that's eating your lunch. And so therefore, you've had to compete against someone who had advantages that you did not have. And so therefore, movement of capital, the movement of businesses happened. Now, we think that means the remaining companies that are here have right-sized, downsized, consolidated, so that you have a very different industry structure with tough mutters who've competed and are in a good place today, especially since the underlying economics is in the process of it already has started to change, and it's clear and identifiable. There's a dramatic period of time of growth in front of it. So there's a fertile opportunity as opposed to you fighting huge headwinds. So we think that's a critical part of how we identify the right kinds of companies to invest in. And there's a lot of right kinds of companies today because there's a lot of companies that people just don't want to look at. There are industries in which I just don't invest in that industry. So a cyclical industry that's commodity related, I don't want to do that. However, I'll remind you that things change, right? There was a couple of decades in there. There was a decade from 2000 to 2007, really. Well, look who the winners were. Those were all commodity companies. And why did that happen? Because China's ascendancy of its economy began a huge appetite because China had started out as a place that was self-sufficient, that had all these natural resources, but his economy had grown to the point where it suddenly was an importer. It needed to import everything. So, right, if you make steel, 50% of steel in the world is made in China, and yet they need to import iron ore, met coal, and energy. And so the critical, most expensive part of the cost of goods sold are things that they are now importers of. So therefore, at the cost margin, they're probably some of the highest producers, the highest cost people there. So things changed, and what drove that was that underlying economic environment. And of course, in the 70s, people didn't suddenly say, I want to go out and own an energy company. But of course, that was the oil embargo, the shortage in energy, and energy was a place in which the economics was particularly strong. The economics drove it. It's the economy, stupid. That's what drives winners. What's the economy like for the next 10 years? And that's what we think it's clear and identifiable where it is and where it ain't. So that's what we think is, a couple years ago, people heard, after 22, right, 22 was a very odd market. Everybody's kind of forgotten about 22, I think. Bonds are down 10%, stocks are down 10%, everything changed. Of course that changes, because right when you change the risk-free rate of return, and you go from 1.5% to 4.5%, the capitalization of everything is radically different. Your multiples are different. Your cap rates are totally different. And so we'd submit that a lot of that has not caught up at all because it's predicated on, no, we'll get back down to 2% inflation, and then maybe 2.5% is the right number, and then it'll be okay, and we'll Brigadoon will come. It'll come. We don't think that that's really going to happen. So instead, we don't talk about the revenge of the old economy. That's what we talk about as the metamorphosis of the old economy. There are businesses that everybody knows are old economy, asset-intensive businesses that are based in North America that we think today are extremely well positioned, have barriers to entries, have sustainably growing earnings, have high free cash flows, and therefore extremely well positioned. And why is that? Because we see two major themes. So Theo Vandermeer's, I guess, only 34. He reminded me the other day when we were standing on line for Southwest Airline, and his number was 51 and mine was 46, that he was only 34. I said, thanks a lot, you smartass. So anyway, 10 years ago, he said, grassroots macroeconomics. Because that's, as value investors, one of the things I think most say is, gee, I don't know. I look at my company, I do my research, I understand what I think of the drivers of the business, but I don't know what the macroeconomic environment is. So if I buy it cheap enough, I got a margin of safety, I should make a return anyway. And so the reality of it is maybe you don't know what's going to happen to the economy, but if you did, that's a critical thing. And that's what we think is our grassroots macroeconomics stuff gives us information on a company, an industry. Since there are 14 people who've been doing this for 10, 20, 30, 40 years. The information base that we have, and we've been doing it all over the world, so the knowledge base we have on the industrial part of the world tells us certain things that says there are clear movements here. So the first one is, you hear the phrase over the last couple of years, deglobalization. That's baloney. The world's flat. It's the evolution of globalization. And so it's not just China anymore. And of course, you've seen that for 10 years. Businesses have been moving out of China because China's competitive advantages today are different than what they were 40 years ago, 30 years ago, 10 years ago even. So those businesses are moving to places that are more effective for them to be in. Of course, that process is accelerated by the fact that we're concerned about supply lines, concentration of supply, and all of those things. So that's all growing too. So there's a clear movement of the economy continuing to move beyond China to the next step, which of course is a 60-year process. It started, post-World War II in Japan. So Japan had a period of time of significant economic results where it came from post-World War II totally depressed to a place where its natural position it ascended to. Then it became too high cost, and they're too rigid in how they do things, so it moved to South Korea. And then the same thing happened in South Korea. So its ascendancy dramatically changed. And what did it happen? Then it moved to China. And what happened in China? Now, China is bigger than is Japan and South Korea, so it takes longer for China to grow out to its potential. But I'd suggest in many ways China's grown to a place where it's a different place today than where it was. And its advantages today are different than where they were 40 and 50 years ago. And so that process is now moving on. And where's it going to move to? And it's not going to move to one place, and it's not going to move to Vietnam, because Vietnam's 100 million people, it's not 1.4 billion people. It doesn't have the economic development. So it's going Southeast Asia, and it's going to India. So there's a good chance that India's growth over the next decade is going to be a high single-digit number. And so when 2 billion people suddenly start the ascendancy to build out their economies, the call on materials is dramatic. So you need all these things, and you need things like steel, cement, plastics, and all these basic materials that are bad businesses, cyclical businesses you don't want to invest in. But I'd submit in those places there's significant growth that's coming from that. The other one is energy transition. And clearly energy transition is really happening. Of course, it's really happening because China is the main proponent of it, because China is an importer of fossil fuels, other than one, right? Coal is the only one they have natural providence of, but the others they need, and they can't use everything in coal. They need oil, they need gas. So therefore, for them to grow out renewables, clearly they are hell-bent on doing that. And they will do that. And so therefore, and the rest of the world is following in that process. So energy transition is significant. I heard the CEO of First Solar this morning on TV, and he said, it's great too, because not only is it economic to build out these renewables, they're also, like the material footprint is really low, because once you built it out, then you don't need anything. The sun shines and you create electricity. So it's a wonderful business. There's low impact on the environment. And then he says, and then we're going to build all this new stuff in America, but it's great too, because it's going to be new jobs, and we're going to need steel and aluminum and cement, and you go through the material you need to build out the renewables. There's a huge call on materials that are in tight supply today. Tight supply to bring supplies on takes a long time, lots of capital. That's inflationary. So therefore, both of these things, the globalization and the movement and energy transition, are things that will have a high call on materials. Those materials in tight supply today, and harder to get and more costly to get, and countries that have them in a better position to control that process, which means it'll take longer and they'll capture more of the value, which they probably should, as opposed to the North comes down and pilfers it, and moves on, and they're still poor. And so that environment is one in which there are major trends that have already started that have dramatic growth from here, that it's clear to identify who can be winners in that process. And that's what it is. One of them is the reindustrialization in North America, right? So in reshoring, people say, that's what they say, reshoring, which is a bad phrase, because it isn't something that went to China coming back. It's more likely something that is someplace else that's coming here, including it's in Europe, and Europe is economically disadvantaged from an industrial point of view, partially because of its limitations on what it has, and partially of its own decision to therefore be concerned about carbon and the buildup of carbon. So that process is somewhat elective on that process, but it means it's high cost. Effectively, decarbonizing Europe means deindustrializing Europe. So most of what's coming to America is not coming from Asia, it's coming from Europe, but it's also coming from Asia too. So we think those are clear, identifiable trends that have a call on limited resources that are in high demand and growing demand and limited supply. Means if you can invest and own those things, you should be in a very good position to be on the right side. And after all, it's the economy, stupid. If you own a business that's going to have growing earnings and high returns, that's a business capital is going to eventually capitulate and follow and want to own. China, we all know the demographic story, that and many other things. And China's a different place today than what it was. And China will do, 50 years ago when America started the process of 40 years of losing all these businesses to China, I think the U.S. economy didn't implode. I think the U.S. economy grew. So in spite of the fact that there was an evolution of the economy, and it went from an industrial economy to a service economy and a technology economy, it's okay. China will do the same thing. It will continue to be a strong force in the world's economy. The role it will play will be different. And so therefore, it's not, in the meantime, that means its energy consumption and material consumption will continue to strengthen, as well as the rest of the world is going to do the things that China did 40 years ago, and therefore have a high need for these things. The appetite for energy everywhere around the world, as you do all the stuff, everything needs energy. So you need to build renewables as fast as you can, which of course means you need more materials, which means if you have those materials, therefore you're in well positioned to make high returns. So there's a number of things, including energy itself. When you look at the charts in the per capita energy consumption of Japan post-World War II, as its economy therefore improved, it's a hockey stick. Sorry, it wasn't a hockey stick. It was a good high slope up. Then you go to South Korea, it was a hockey stick. Then you go to Japan, in China, it's the same thing, there's huge growth. So, and when you're starting with a base of India, 1.4 billion people, already as big as, the biggest country in the world, and you do Southeast Asia with 650 million people in it, those are really high population areas that have low per capita energy consumptions that are going to grow out their economies and are going to grow their energy needs in the process. And therefore, energy appetite is going to be strong. And we think clearly fossil fuels is forced to play a role in that because you can't build out the renewables fast enough. And we will try to do that as fast as we can, but there's just the physical limitations because you just don't have the materials you need. And that's why, of course, so many businesses are coming to North America, is North America's competitively advantaged, right? For the next 10 years, probably 20 years, maybe longer, energy costs in North America are lower than they are in the rest of the world, right? So we have an overabundance of natural gas. To build out the infrastructure to get it other places takes repeated different pieces of it, and it will take an extremely long time. Our ability to produce twice as much natural gas as what we do today is easily identifiable. So therefore, we have an overabundance of this commodity, which will mean it's the only fossil fuel that trades at a disconnect from the rest of the world. The rest of the world's LNG, oil, coal, all trade relatively comparable to their energy equivalency at a much higher rate than what natural gas prices do in North America. And of course, that means natural gas prices, that means electrical prices. So therefore, that's why European businesses are moving here, because there's a 2-decade opportunity to be in the low-cost place and have excess returns on capacity you build. And I just don't see how that train stops. And of course, the money behind that hasn't come yet, right? The Inflation Reduction Act capital, we haven't seen $1 of that. So it's a process, and the way I think I describe it, it's a tsunami. So it's coming, that capital's coming. It takes time for the government to put the rule in place, figuring out the permitting process, start to allocate the capital. I think I was in Houston the other week and spoke to a guy. 6 companies one day called up and said, I want FEED studies on this project, building this new plant, that new plant, because I got my approval from the Department of Energy in terms of how I can do my project. So the capital coming from that, the capital coming from the infrastructure rebuilding, all those things are coming and are not yet here. So the momentum behind the North American economy is extremely strong. And I just can't see how there's anything that's going to stop that train. And of course, the change in administration isn't going to, no one's going to stop providing money to provide capital, to provide jobs, to provide economic growth. Nobody's going to do that. And here's some examples, right? Nippon Steel, comes and pays a huge price to buy U.S. steel. Why is that? Because all the Japanese clients who already do business here, Hitachi and other people are saying, I want to grow my North American footprint. That's where I want to be. And so I want to follow my customer. And my customer is going to build out their North American footprint. I got to be here. And so they even broke away from their partner. Their historic partner in that business is ArcelorMittal. In many parts of the world, they have joint ventures with them, including in the United States, they have a bunch of joint ventures with ArcelorMittal. ArcelorMittal was a little bit surprised, disappointed, shocked that Nippon went on its own to make that bid. And there were probably repercussions. But it just goes to show the interest in being in North America. You get Holcomb Cement is spinning off the North American business. Why? Because one's going to trade at an okay price and the other one's going to have dramatic growth. And therefore, I can have a separate security that trades in the U.S. market. I'm going to get a much higher valuation on that component of my business. And it's going to need more capital because it's going to grow because I'm going to build out my footprint there. So and of course, TSMC is building the plant in Arizona. It's going to cost much more to make chips here than what it does in Taiwan. But the fact of the matter is you've got to have diversity of supply. And so therefore, that's inflationary. So, and to me, it's like whack-a-mole. How do you think you're not going to have inflation? I just don't see look at the facts around you. There are so many indicators that inflation is going to be a recurring, persistent issue. And then that means the risk-free rate of return is wrong. The capitalization rates are wrong, the discount rates are wrong. The valuations on many parts of where capital is allocated today have not adjusted to that potential environment. And instead, they're based on the hope that inflation goes away. So, as I said, U.S. Steel is a clear indicator of kind of the interest in being here, the opportunity, the ability to this market to grow. Its market is also self-sufficient, and because it has iron ore we mine here, met coal we mine here, and low-cost energy. So the main critical inputs are secure and low cost in North America. And yet the end market, the U.S. is a great end market as is, but the growing in reindustrialization is going to have a big appetite. Whether it's reindustrialization or whether that's energy renewal and building out wind and solar, the amount of steel that you're going to need to do that is dramatic. So it's a growing market that has very attractive long-term opportunities that are clear and in place. The specific company I'm going to recommend is ArcelorMittal. So ArcelorMittal is the second largest steel company in the world, and outside of China, it's the largest in the world. So Mittal family, originally from India, has spent 40, 50 years building this company. We think they've been extremely shrewd and successful in that process. So you have an inside owner-operator who owns 40% of the company, and that's a critically important part of the investment thesis. In addition, they have many different projects underway that we think will dramatically increase the earnings over the next 3, 4, 5 years. They're part of energy renewal, the build out of infrastructure, new energy, you name the macro trend that I mentioned before, which are strong and growing. They're a participant in that process, selling a critical element, and that is steel. And they tend to also be very focused on trying to do that with as little carbon output. So this is a hard to decarbonize industry. And so therefore, they are at the forefront of doing what they can to reduce the carbon footprint. In a place like Europe, that's extremely important. That's a differentiator for them. What they also do is, I would imagine, I'm a financial guy. I think of steel as steel as steel as steel. I don't know what steel is. And the fact of the matter is there are many different grades, there are many different products, there are many different uses. And therefore, if you focus on different markets, the pricing that you get is vastly different. The supply-demand dynamics is different. The consistency in the business is very different. And ArcelorMittal spent 40 years in identifying the products you want to be in that have higher margin, higher value, higher returns. And so they've done a great job in positioning the business too. And in addition to, so where they are, so they're in North America, so the critical market. They're in Brazil, which is a critical market that will grow over the next few decades. The European part of the business, that probably is more stagnant, but of course what they're doing and how they're changing it and how they're decarbonizing it is making a critical thing, and you're still going to need steel in every market. And then of course they have a very big joint venture with Nippon Steel in Japan, where there are 3 operators that make steel, so there's an oligopoly. The outlook and expectation is that the growth is going to be high single digits over the next decade. The capability to build out their capacity from where it is, they're already in phase 1 of that. So it's going to dramatically grow. And so therefore, we would also submit that we think this company is a major beneficiary of India. And of course, if you want to buy an Indian stock, I think most times you got to pay 30, 40 times earnings. So here you could pay 5 times earnings to get a company that is extremely well positioned to be a major beneficiary of the build out of the infrastructure of India. These are all the needs and uses that you have for this product, and therefore we think the end market demand significantly grows. And what they've also done, owner-operator, so what they've gone about is, for the last 10 plus years, there's been a dramatic amount of free cash flow. What have they done with that? First they started with, well, in order to amalgamate this thing, they borrowed money like crazy and they built this thing up. And now they've been spending the last 15 years, okay, let's pay down the debt. We don't want that much debt. This is a capital-intensive business. And so that's what they've done. They've effectively reduced the debt to 0. So then what they started was, okay, so in 2020, they got the debt down to almost 0. They said, okay, we don't need to pay down debt anymore. There's a whole bunch of projects we want to invest in that we think we can grow. So we're going to invest in growth opportunities, CapEx, but we still have a whole bunch of extra money. What are we going to do with it? So in the last number of years, they bought back over 30% of the outstanding stock of the company. And they continue to buy back stock. So what you have, we think, is a company that you can buy for a modest multiple of earnings. By modest, I'm talking 5-6 times earnings, less than half a book, generating a 9% return on book. So if you buy it at a third of book and you do 9% return, you talk about 27% return on invested capital. That is invested in the growth in the business. So therefore, the top line is going to grow. The earnings currently are depressed because 50% of the steel in the world is made in China. And China is, in the last 2 years, we'd submit, people talk about, oh, I don't want to invest in the market because there may be a recession. And we're like, in our businesses, I said, wait a second, stop it, guys. Well, who cares about the recession in America? The recession that matters is China. And China's been in a recession for 2 years. And so therefore, and what has China done? China has overproduced the things that it can produce and flooded the world. And so therefore, and of course, what that's done is, in Europe, the European businesses are hurt continually by cheap imports because China produces as much as it can and it dumps it on the rest of the world. That's what its process is. So therefore, it has nominal growth by overproducing and exporting. So whether it's chemicals, whether it's steel, there's a lot of products that China has overproduced for the last 2 years and depressed the rest of the world's economy, and therefore nominally saying that they have growth. We don't think that's the permanent state of affairs in China. I think China's economy will recover, will recoup, will grow. Okay. And so these are like a number of the things kind of underway, and that's what we think there's a really good chance that in the next, you take off the pressure that there is in the current earnings, they go back to where the normal state is, and you can look back a couple years ago where potentially that might be. You have the growth projects they have. We think there's a good chance that over the next 3 to 5 years, the earnings above the line can double. The share count is clearly declining. How much is it going to decline? So you can buy a business trading at 5 times earnings that can self-finance the growth, that pays out dividends, that buys back stock. So the valuation is dramatically discounted. And where does it do that? It does it in North America, it does it in Brazil, it does it in India. Markets that are going to have a decade of growth in front of them. I went down to Argentina, went on a Jeffries trip, spent 3 days. We think the resource rich of the South, and Argentina is one of those places. So the government changed that, who knows what will happen and what success is. The fact of the matter is they have they are long resources, and would you rather develop in Argentina or would you rather develop in the Congo? So there's a huge opportunity, we think, that is basically predicated on that, in addition to maybe the government gets traction on what they're looking to do, and there's a dramatic opportunity for growth in a place like Argentina. The other thing is copper. We think that copper is clearly a commodity that we all know. Energy transition, all these things, there's a huge demand increase for copper. Where do you get it from? You see what's going on, right? The biggest copper company is buying one of the other big copper companies to get bigger because I can't build it out fast enough, so I might as well buy this thing as quick as I can. So you had the BHP bid to buy Anglo American. Last year you had Rio Tinto take Olin Togoy private. You had who bought Oz Mineral. So these companies are buying up the copper companies because you can't build copper fast enough. And I was down, I spent a week in Chile in September. And when you go around the process and you hear what Chile says is, you can't use groundwater anymore. You have to desalinate the water. That will cost you 10 times as much money. And the desalination increases the energy footprint of that mining by 30%. And that project's going to take you longer because we're going to need to approve that. And if you're Indonesia, Freeport-McMoRan, when you develop that resource, no. You're going to build a refinery here in Indonesia. You're going to refine it here in Indonesia. We're going to capture more of that value. So these countries are in possession of these materials that are in growing demand that control it and are in a better place to capture the value associated with that. So we think there's a plethora of places around the world. And as a result, our last thing here is markets are responsive to economic environments. That's our critical message. Right? We believe the next decade is the return of the stock picker. It's the restoration of the fallen value investors. And we think there's a really good chance the FTSE 100 outperformed the NASDAQ 100. Because what's in the FTSE 100? It's not technology stocks, so that's the losing index, but they do have oil, gas, mining, emerging markets. They have the places that are heavily discounted today, that have great growth in front of them, that will be the beneficiary of the economics for the next 10 years. Past performance is not an indicator of future results.